Hello, everyone. Welcome to the training. This is the Forex Made Easy Academy, and this is the second video in the series of our training that we will be sharing on this space. Now, if you know you have not seen the first video, I left the link in the description of this video. Please go and see the first video that gives you the basic introduction to the concept of Forex trading, or the things you need to know, and how the forex market works. Okay. um the first thing I want to establish here is this: if you have zero knowledge about forex trading, this is a series that would help you achieve these results so that you can start trading profitably. Now, in this video, we'll be talking about understanding major and minor currencies. Like I said in the previous video, when it comes to forex trading, you are trading one currency against the other. So you are trading a particular currency against the other. So what are currency pairs, or what is a currency pair? Currency pair is a quotation of two different currencies with the value of one currency being quoted against the other. In forex trading, currencies are always traded in pairs because the value of a currency is relative to another. Each currency pair consists of a base currency and a quote currency. So for every time you hear the concept of currency pair, two things comes to mind. What are they? That there are always two currencies being traded. One is being sold while one is being bought. So we are buying one while you are simultaneously selling the other. Now, the one you are buying, for example, is known as the base currency, and the one you're selling is known as a quote currency. An example here is the euro against the US dollars. Now, the euro in this example is the base currency, which is the first currency in the currency pair. And of course, the USD is the quote currency, that is the second currency in the currency pair. I hope you understand it very well now. So it's very simple to understand. So if I come and I say, okay, it is the USD against the Japanese yen. That is, the USD is the base currency, while the Japanese yen is the quote currency. If I say it is the euro against the Canadian dollar, the euro is the base currency and the Canadian dollar is the quote currency. So it is, you are buying a currency while you are selling what the other currency. So this is the difference between what the base currency and the quote currency. Now, another thing you must know that unlike the New York Stock Exchange or the London Stock Exchange, the forex market has neither physical location nor a central exchange. The entire forex market is run electronically within the network of banks, or within a network of banks, continuously over a 24-hour period. One of the advantages of the forex market is it is accessible. It is open 24 hours, 5 days a week, which is usually from Mondays to Fridays. The next thing we'll be considering now is the 8 most traded currencies in the world. Now, these currencies are the major currencies traded most times in the global market. What are the currencies? These are the US dollars, which is the USD. You have the euro, which you have the Japanese yen, you have the Swiss franc, you have the Canadian dollar, you have the Australian dollar, and of course you have the New Zealand dollar. So I said in the beginning of this training, or the previous video, I said that you cannot trade just one currency. You are always trading one currency against the other. You get it now? You are trading one currency against the other. So you can trade the US dollars against the euro, or you can trade the euro against the Japanese yen, or you can trade the US dollar against the Canadian dollar, or you can trade the euro against New Zealand dollar. So it depends on what you are trading or what you're working with. So like I said before, there is always a currency pair for a trading to go onward successfully. Now, having said that, the next thing we look at now is what pair is actually about. I'm going to get a little bit more, I'm going to divulge more information about the concept of pair, because pairs that involve any of these major currencies typically have the smallest spreads and the largest trading volumes. Now you see something like spreads. It's a concept which I would explain in a subsequent video. And of course, we'll talk about trading volume as well. Now, in my slide here, I said pairs that involve any of these major currencies typically have the smallest spreads and the largest trading volumes and are known as major pairs. Examples of major pairs include the euro against the US dollars, or the US dollars against the Japanese yen, or the Great Britain pound against the US dollar, while the minor pairs, also known as cross-currency pairs, or simply crosses, are currencies pairs that do not include the US dollars. So major currency pairs always include the US dollars, while minor currencies pairs, they exclude the US dollars. So you get the difference now. So if someone asks you now, what are the major currencies that are traded in the world? You have the US dollar and everything. The US dollar, the Canadian dollar, the Great Britain pound, the euro, the Japanese yen, all of these. But now there is difference between the major currencies and the minor currencies. Okay. Now the major currencies is when you are trading any of these currencies against the US dollar, while the minor pairs, or the minor pair, is when you are trading any of the currencies, but you're not trading it against the US dollar. Okay, so for instance, now if you have the euro and the Great Britain pen, that is a minor currency. That is a minor pair. Sorry, if you have the Great Britain pen against the Japanese yen, it's a minor pair. If you have the euro against the Swiss franc, it's a minor pair. If you have the euro against the Canadian dollar, it's a minor pair. But the moment you have any of these major currencies against the USD, or the USD against any of these major currencies, instantly you are trading what? A major pair. I hope this concept is quite understandable. Then the next thing is this. Now, example, in the pair euro against USD, the euro is the base currency and the USD is the quote currency. I made reference to this before when we talk about the base currency and the quote currency. And the base currency is always the first currency in the trading pair, while the quote currency is the second currency in the trading pair. Okay, for instance, now if the euro against the USD is trading at 1.1850, it means that 1 euro is worth 1.1850 US dollars. I hope this is quite understandable. So in case you don't understand this again, the perfect example here is this. I said when you are trading, you are always trading currencies. You're trading one currency against the other. You're buying one while you're selling the other. You're buying one while you're selling the other. So the example we're having on my screen right now is, for instance, if you have a pair which is an euro against the US dollar, it means that the euro is the base currency and the USD is the quote currency. Now, in this trading pair, the euro is worth 1.1850 US dollar. That is the worth of 1 euro against the dollar. Do you get it now? So in this case now, you have the base, you have what? The quote. So I will tell you which of them is you are buying and which of them you are what? You are selling. So having said all of this, the next thing we have to consider now is the characteristics of currency pairs. What are those things that you must look out for when it comes to what? Currency pairs. Okay, each currency pair has certain characteristics, and these include the following. One, volatility. Some currency pairs are more volatile than others. For instance, the Great Britain pound against the Japanese yen is known for its high volatility, which can result in larger price movements. Then the other characteristics of currency pair is spread. So if you don't understand the concept of volatility, spread, and all this I'm talking about now, don't worry. I'll be doing a subsequent videos that explain all of these things bit by bit. So just ensure that you see subsequent videos and then you learn what you have to learn. So it's not just a day business, okay? So let's just keep going because I want to be as fast as possible. Now, the next thing I said about this now is what the spread. Now, the spread is the difference between the buying and the selling price of a currency pair. there is something called ask and bid price. But we are coming to that anyways. So just take a deep breath and follow. And if you have any question that you want me to actually probably explain properly, just take the comment section and ask your questions. I will be glad to respond to them. Or you can send me a DM using the link in the description below. Now, I said that the spread is the difference between what the buying and the selling price of a currency pair. Now, major pairs typically have smaller spreads more than minor pairs. I've told you what major pairs are. I've told you what minor pairs are in this same video. So if you say what is not a spread or what is the spread is what the difference between the buying and between the asking and the bid price for each of the currency what pair. Okay, did you get that now? So having said that, the next one we'll be considering here is the third thing. The third thing there is after volatility, after spread, the next characteristics or the traits of currency pair is correlation. Now, some currency pairs are correlated, meaning they move in the same or opposite direction due to similar economic factors. For example, the Australian dollars against the US dollars and the New Zealand dollar against the US dollars. These often move in the same direction because both Australia and New Zealand have similar economic ties and geographical proximity. Now, example of correlation: if the Australian economy is doing well and its interest rates are higher than other countries, both Australia and New Zealand, that is the Australian dollar and the New Zealand dollar, can strengthen due to similar economic factors. Therefore, Australian dollars and the US dollars and the New Zealand dollar and the US dollars may both rise. So in this case, when talking about correlation is when you have two countries like the Australia and New Zealand who have similar economical and geographical ties proximity, that if one is probably going up, there is a tendency that the other will be going up. So if you have a trade that is Australian dollar against the US dollar or the New Zealand dollar against the US dollar, if the Australian dollar is progressing or it's been strengthening, do you know that that same thing can also be applicable to the New Zealand? That is the whole concept behind correlation. Now, the other thing there is that understanding the characteristics of each currency pair can help you make more informed trading decisions and manage your risk better. So what are the things I've told you so far? I talked about volatility, I talked about spread, and I've talked about correlation. Okay, so you must know all of these at the back of your mind when it comes to your trading. Now, for instance, if you know that a certain pair is highly volatile, you might decide to trade with a smaller position size to limit your risk. Remember, while understanding these concepts, it is crucial. Relearning comes from practicing trading and getting experience in the market. It's always advisable. I would always tell beginners that before you start trading, you don't fund your account and then you start trading with the money that you used to fund your account instantly. You learn to trade and then you fund your trading by starting with practicing from a demo account. So basically in this video, I've talked about currency pairs, I've talked about major pairs and minor pairs, and then I've talked about the characteristics of currency pairs. Okay, so that is all for this video. Thank you so much for seeing this video. My name is Daniel Ibomo, and if you have any question, please don't forget to leave them in the comment section. Don't forget to hit the like button and give this video a thumbs up. Hit the subscribe button. Share these videos with your friend. These trainings are free, so do well to also invite somebody and let them be part of this. Thank you so much. I will see you in the next video.